Great. So we're now recording. Welcome, everyone. Thank you so much for joining. My name is Rebecca Lammers. I'm the chair of the Democrats Abroad Taxation Task Force. Moderating the chat today is Charlotte Devernaugh and Betsy Attore. And we have an extra special guest here. Caitlin Minnow from Bright Tax is going to be our presenter for today. Just a reminder that we are recording the webinar now, and if you RSVP'd for the event, you'll get a link to the recording after the webinar. So if you missed anything, don't worry, you'll be able to watch it back later on. I need to read the disclaimer. So I'm going to read this now and then we'll carry on. So Democrats Abroad cannot provide individual tax advice. Advice requires consideration of your individual circumstances and needs, none of which can be done on this webinar. We are not tax lawyers, accountants, or advisors. Please consult a professional tax advisor, accountant, return preparer when addressing your personal tax matters. Democrats Abroad does not endorse or recommend companies or individuals attending or hosting this webinar. The views expressed at this event are those of the respective individuals and companies, not Democrats Abroad. No liability is accepted by Democrats Abroad for the opinions expressed or for any errors or omissions expressed about matters of tax in any country, your financial planning, or your legal obligations. If you are in need of tax advice, you can consult the American Citizens Abroad Tax Return Preparer Directory to find an advisor or tax return preparer near you, or providing online services to meet your needs and budget, though buyers always need beware. Great. So now that we have the formality out of the way, I'll get through to the agenda actually. So we're just completing introductions. We're then going to have about a half an hour for Caitlin to talk through, I'm so sorry, I didn't update that, to talk through what's the best tax strategy for you. It's mostly talking about the foreign tax credit versus the foreign earned income exclusion. And then we'll come back and I'll do a few announcements, and then we'll finish off with the Q&A. One of the things that I wanted to ask before we get started is that this is a free webinar, but we would really super appreciate a $10 donation. The Democrats Abroad Taxation Task Force is a group of volunteers who spend a lot of time working on speaking to Congress and making advocating on behalf of Americans abroad to improve the tax situation for Americans abroad. We are going to be going to Washington, D.C. to meet with tax writers and legislators in the first week of June. And so we're trying to raise money in order to get there. So we would really super appreciate a $10 donation. If you can't afford that, give what you can. And if you can give more than $10, we'd really appreciate more. And also, if you can't donate, please do consider donating your frequent flyer miles. We'll put a link to the email address you can contact us on how to donate your frequent flyer miles. So with that, I will hand it over and stop sharing my screen and hand it over to Caitlin.
Excellent. Thank you so much, Rebecca. And I will begin sharing my screen. Are you able to see that? Perfect. All right, so I'll dive right in. Thank you everyone for the opportunity to be here and speak with you all today. My name is Caitlin Minot. I am a CPA and the CEO at Bright Tax. We are an online tax preparation firm providing a CPA relationship to Americans located all over the globe. And to dive right into the content of our discussion today, here come the agenda points that we'll be discussing. We're going to start out by talking about what are the FEIE and FTC. Those are some tax acronyms that we use frequently in the world of tax preparation. When should you use each of those tax tools to prepare your U.S. tax return? Other considerations beyond the FEIE and FTC. And then finally, as Rebecca shared, we will be having the opportunity to answer your questions at the end of the presentation. So to start out, what are the FEIE and FTC? The FEIE is the Foreign Earned Income Exclusion, and the FTC is the Foreign Tax Credit. And these are tools that we use in tax preparation to eliminate double taxation and reduce your tax bill when preparing your U.S. tax return. So regardless of where you live or work, As an American taxpayer, as a US citizen, the US requires you to report your worldwide income, which creates the possibility of double taxation. These tools can be used to eliminate that double taxation. There are certainly other tools out there beyond the foreign earned income exclusion and the foreign tax credit, but these are the two, I would say, most well-known and most highly used tools to reduce your US tax bill. So let's start out with the foreign earned income exclusion. The foreign earned income exclusion is a tool that we take on Form 2555, and that gets filed with your US tax return. It must be filed in a timely manner. And when we say in a timely manner, that deadline is associated with the deadline of your tax return, whether that's April 15th, June 15th, October 15th, or December 15th. The way that the foreign earned income exclusion works is that it actually reduces your taxable income and thereby reducing the associated tax liability. But the tool takes your overall tax and reduces it by the exclusion amount to arrive at your taxable income. The foreign earned income exclusion is only for earned income. So here we're talking about income that you're actively participating in to earn, including wages, freelance income, which is also known sometimes as sole proprietorships income, independent contractor income, for example. And in the 2021 year, though the foreign earned income exclusion maximum threshold is adjusted each year for inflation, the maximum exclusion this year for the return, the 2021 return that you'd be preparing now, is $108,700 US. So sliding over to talk about the foreign tax credit, which is again another tool that we use to eliminate double taxation. The foreign tax credit is filed with the tax return as well on Form 1116. The timing, though, on the foreign tax credit is a bit more flexible. When you use the foreign tax credit, you actually have up to 10 years beyond the original due date of the tax return to file the foreign tax credit and take advantage of its benefits. That said, certainly most people will take advantage of it in a timely manner on their annually filed tax return. The foreign tax credit reduces your tax directly. So unlike the foreign earned income exclusion, it doesn't reduce your income, but it's a direct credit from your tax bill that's calculated as a result of your income. It can be applied to any type of foreign income. So wages, investment, pension, which are all types, investments and pension are types of income that are not considered earned income for purposes of the foreign earned income exclusion. The foreign tax credit can be applied to any foreign income type. And the limitation on the amount of foreign tax credit you can take is the amount of US tax related to your foreign income on the tax return. So when can you use these tools and when should you use these tools? Because certainly in some cases you're able to use them, but it may not be to your advantage too. The foreign earned income exclusion can be used when you have a tax home abroad. So that's the first criteria that you must meet in order to take advantage of the foreign earned income exclusion. And so what is a tax home? A tax home is your regular or principal place of business, employment, or post of duty, regardless of where you maintain your family residence. So generally speaking, your tax home is where you work. Once you've met the tax home abroad test, meaning your tax home is located outside of the US, then you must meet one of two criteria in order to utilize the Form 2555 exclusion. The first being the bona fide residence test. If you have resided abroad for one full calendar year, you can then call yourself a bona fide resident as the minimum criteria. Other factors that contribute and support your case of being a bona fide resident abroad include paying taxes abroad, having a permanent residence visa abroad, and having your family abroad with you. If you don't have a bona fide residence abroad, there is another test called the physical presence test. And this one is a little bit more clear cut, black and white. It's a simple test of how many days you were physically absent from the US during any 365-day period. Both of these tests, it's important to understand, can be applied to a portion of the year. So if you've moved abroad midway through the year, it's possible that you'll qualify for a partial exclusion, applying the foreign earned income exclusion to the part of the year that you've met the criteria. whether that be criteria for the bona fide residence test, in which you might be retroactively applying the test, or the physical presence test, in which, again, that 365-day period doesn't necessarily have to align with the calendar year. So when should you use the foreign earned income exclusion? So you may have seen the ways in which you can use it, but it doesn't necessarily mean it is necessary or relevant to all taxpayers, or beneficial, of course, to the outcome of your tax return. Where the foreign earned income exclusion is exceedingly beneficial as part of the tax return preparation process is if you don't pay foreign income tax in the country that you reside in or work in, or the tax rate in the country that you live in or work in is lower than the US rates. The foreign earned income exclusion is extremely beneficial for digital nomads, so people who are moving their tax home from place to place throughout the course of the year. The tax home that we talked about can follow you from location to location. So perhaps you weren't in one country consistently throughout the course of the year, but rather you were consistently absent from the US. Therefore, that digital nomad lifestyle can allow you to utilize the foreign earned income exclusion. Of course, there are a handful of income tax-free countries. Some of those that we commonly see with our clients are the British Virgin Islands, Qatar, UAE. In those countries, there is no income tax, and utilizing the foreign earned income exclusion to reduce our clients' taxable income is a meaningful way to reduce their US tax bill. Another interesting way that we see people apply the foreign earned income exclusion, and where it is also very beneficial, is people who have an income-driven student loan repayment that you'd like to continue to defer. Often student loan evaluators look at the amount of income after the foreign earned income exclusion on your tax return. And as a result, the amount that you actually have to pay back on an annual basis can be reduced. If that's something that you wish to, of course, pursue, that's one way to strategically approach your US tax return. Another place that we saw in the last couple of years, the foreign earned income exclusion creating benefits for taxpayers is with respect to the COVID stimulus payments that were distributed during 2020 and 2021. The economic stimulus payments had income thresholds associated with them, meaning taxpayers outside of certain income brackets weren't able to take advantage of the COVID stimulus payments. But those who took the foreign earned income exclusion, thereby reducing their taxable income, were in some cases able to pull themselves into the threshold of qualification for the COVID stimulus payments. So the foreign tax credit, when can we use it? You can use a foreign tax credit if you have paid income tax to a foreign country. I highlight income tax because there are many different types of taxes that a foreign government might apply to your income. So when you've paid income tax to a foreign country, you can then take advantage of this mechanism. The foreign tax credit can only be applied to foreign source income. And why this is important is because without that foreign source of the income is therefore considered US source, and we can't use the credit to reduce your tax. The table below, I won't read through in detail, discusses a few different types of income and the source of that income. What is driving the source of that income? So for wage income, if you're employed, the source of that income is actually where you work. A common question I get is, I live in, for example, London. I work remotely for a US company. They pay me in US dollars to my US bank account. My clients are in the United States. My colleagues are in the US, but I live and work in the UK. In that case, the source of your income is actually driven by where you sit and work from. That varies from these other types of income, which have different driving factors in terms of where the income is sourced. Rental income is sourced where the property is located. It looks like that one got mixed up with capital gains there. Capital gains are sourced in your residence country, and pension income is earned where you worked at the point where you're accumulating that pension income. There are also circumstances in which a treaty between the US and the country that you reside in can make the foreign tax credit possible, even if the source of your income wouldn't typically be foreign. This is a process called resourcing, and the treaty can be interpreted in such a way that income that would otherwise be US sourced can actually be redefined as foreign sourced income. So when should the foreign tax credit be used? Couple common instances in which we highlight and emphasize the use of the foreign tax credit include if you have US citizen dependent children with social security numbers, utilization of the foreign tax credit instead of the foreign earned income exclusion can make you eligible for a refundable child tax credit. And what that means is that even if you're not paying into the US tax system, you could potentially be eligible for a refund of that child tax credit. Other uses of the foreign tax credit include if you have non-earned income types. So investments, pension, rental income. So where the foreign earned income exclusion can only be applied to earned income, the foreign tax credit simply can be applied to foreign income. When you pay higher taxes abroad than you would in the US, which is quite common in European countries. I saw a lot of those as everyone joined us at the beginning as your countries of residence. But in those cases, the foreign tax credit is often the way to go. And the last case that I'll share here is if you would like to continue to contribute to an IRA or a Roth account. And the reason is that in order to make a contribution to those types of US-based accounts, the foreign earned income exclusion would reduce your earned income, thereby reducing or eliminate the available income for an IRA or Roth contribution, whereas the foreign tax credit doesn't come into the calculation until after the earned income portion is calculated. So just an insider tip from a tax pro with a couple of years in the industry, I always try the foreign tax credit first. Why? Carry forwards is the first reason. The foreign tax credit can be carried forward for up to 10 years and carried back 1 year. So if you are in a country where your tax rate is higher than the US rate, you're only going to use up credits to the rate of the US tax bracket. And then beyond that, where you have excess, you can continue to carry that forward. And where that has been very helpful in some situations is where perhaps potentially you have a tax-free or a tax-reduced income event that you can then apply that towards. Travel is another big reason. The foreign tax credit doesn't limit your ability to travel to the US. So while in the foreign earned income exclusion, the IRS wants to know your travel dates to and from the US to kind of gauge whether you are truly qualifying, the foreign tax credit doesn't ask those questions. It doesn't depend on your absence or your visa status or your tax home. It simply depends on the source of your income. And then the final consideration is that once you begin using the foreign earned income exclusion, if you opt out, it means you can't use it again for another 5 years. So getting into the cycle of using the foreign earned income exclusion and then backing out can be a bit challenging from a tax planning perspective. So then the question is, do you have to pick one? And the answer is no. Fortunately, you can couple together these two mechanisms and achieve the most tax efficient situation. If you apply the foreign tax credit and find that it's not completely wiping out your US tax bill, you can then also apply the foreign income exclusion and see if that creates a more efficient situation. That said, you can't apply both mechanisms to the same income. So if you're applying the foreign earned income exclusion to the first $108,000 of your income, you can only apply the foreign tax credit to income above that threshold. And utilize both to achieve the most tax efficient position for you. So we can talk briefly about other considerations because I know sometimes learning all of this brings up other questions. Monday of this next week, the 18th of April, is tax day. I know we have lots of people coming in the door this week and saying, you know, the 15th of April is coming up, it's tax day. And there are of course, there's of course an understanding that April 15th is the tax deadline. But that said, for these mechanisms, including the foreign tax credit, you'll need your foreign tax return filed first, because you need to have a clear number in order to apply those tax credits to the US tax return. So April 18th is in theory tax day. However, for those who reside abroad as of the 18th of April this year, usually the 15th, but Friday is considered a holiday and they pushed it out to the 18th this year. The 18th is the deadline to make payment to avoid any sort of interest accumulating on your tax bill. The date to file and pay your taxes for those who reside abroad as of that date is in fact June 15th. So while interest accumulates between the 18th of April and the 15th of June, you won't accrue any sort of penalty until after June 15th. Knowing that the tax preparation exercise in foreign countries happens periodically through the first couple of months of the year, many people won't be ready to file their US tax return in time for the June 15th deadline. And as a result, oftentimes an extension to the 15th of October is necessary. And the October 15th extension can be electronically filed online. It's kind of a painless process of submitting that form 4868 to the IRS and getting the additional months that you need to file. That said, if there's still not time before October 15th to get things filed, there's a final extension to the 15th of December. I don't recommend this one personally because you actually have to put a letter in the mail to the IRS and hope that they'll accept it. This is one extension that they can reject. And right now at the IRS, there's a very significant backlog of mail. We've seen clients probably in the last couple of weeks who filed an extension last September and October, finally just getting their mail back from the IRS about those extensions. So to play it safe, October 15th as your final extended deadline is probably the best bet. For others, this presentation may have driven a confusion about your filing requirements, or you've just realized that you have to file US tax returns. So if that's the case, maybe you haven't filed in a while, maybe you haven't filed ever, there is a procedure called the streamlined procedure available. It's a penalty-free way of getting caught up. We highly recommend it. We've been doing these for more than 10 years now at Bright Tax, and it's an extremely successful way to get back in compliant into the US system. It requires that you file 3 years of past due tax returns, 6 years of past due Fbar disclosures, and the Fbar is a disclosure of your foreign accounts. It requires absence from the US for 330 days during one of the 3 years you're going to be filing. You submit, in addition to the returns, a letter certifying that you had non-willful conduct in not filing your tax returns. And the only requirement beyond the 330 days is that the IRS hasn't contacted you. So beat them to it. That brings me to the end of the content of my presentation. Rebecca, I think you wanted to jump in next before we go to questions. Is that right? Rebecca, I think you're still on mute. There we go.
Thank you so much, Caitlin. That was really super informative and really interesting. Hopefully you can see my screen now. Is that right? I wanted to open it up for the Q&A at this point, but what I'm going to do is, while the questions are coming in on the Q&A, I'm just going to make a few announcements so that it gives you guys time in order to submit your questions, and then we can go into the Q&A section here. I just wanted to make all of you aware that the reason that Democrats Abroad hosts these tax education webinars, we actually get a lot of people asking us, why is Democrats Abroad a political party hosting tax education webinars? Well, the bottom line is that we think that the US tax code is unfair, and it's complicated, too complicated for Americans abroad. That's why the Democrats Abroad Taxation Task Force exists, which is a group of volunteers who are working on advocating for changing the tax code to make it easier for Americans living overseas. And we believe in education so that people know where the problems exist, and so that they can vocalize them to US Congress, who has the power to change the laws. So that's on a high level why we host these tax education webinars. Included in our work, we advocate for a switch to residency-based taxation, where Americans living abroad would not have to double file or be double taxed. We advocate for eliminating the Foreign Account Tax Compliance Act, which is FATCA for short, reporting of foreign accounts of Americans abroad. The reason for this is that a lot of Americans living abroad aren't able to open a bank account in the country that they live in, and this makes it very, very difficult for Americans living in the country that they live in. We also believe in exempting American business owners abroad from the GILTI and the transition tax. And our Democrats Abroad Global Seniors Caucus works really hard on repealing the windfall elimination provision, also known as WEP, for Social Security. And that is something that up to 30% of Americans living abroad have their Social Security reduced. So if you're interested in reading more about our advocacy work, you can go to democratsabroad.org/taxation. I also wanted to let you guys know that we host tax education events all the time. We have a number coming up over the coming weeks, given that it's tax month. So next Thursday, that's actually next Tuesday, we have the Taxation Task Force volunteer info session. And next Wednesday is a tax education webinar in DA Germany. About US taxes abroad. We also have events coming up in France and in the UK. So for more information on tax events happening near you, you can go to democratsabroad.org/taxation_events in order to sign up for those events. The other thing I would like to bring to your attention is that currently for the month of April, Democrats Abroad has what is called the 2022 Tax Survey of Americans Abroad. So what we would really like for all of you to do on this webinar today is to fill out this survey. We need as many people as possible who are living abroad to tell us where are the problems that they're experiencing with taxes and financial access. We did a tax survey in 2019, and we had just under 10,000 people respond to that survey, which is a huge number of people. And so far this month, we've had just over 3,000 people respond to our 2022 survey, but we still have another 7,000 to get. So help us get to 10,000 by filling out the survey yourself. Share it with your friends and family who are living overseas. Any American abroad can fill it in, even people who are not Democrats Abroad members. You do not have to be a Democrats Abroad member to fill in the survey. And the survey is also completely anonymous and all of the questions are optional. So anything that you share with us will not be traced back to you. So again, the deadline to complete that is on April 30th. We do really strongly recommend that people do it sooner rather than later, because it does close on April 30th. And if you have any problems or technical issues or anything, you can email us and we'll help you out. But just be sure to don't do it last minute so that you can fill it in. And just as a last plug, please make sure that you donate for this webinar so that we can host more webinars in the future. And other things that you can do, Bottom line is one of the best things that you can do is register to vote in US elections. If you haven't done that yet this year, please go to votefromabroad.org. It's really super important that as many Americans living overseas as possible vote in US elections. One of the problems that we face in speaking to Congress is that they don't think that there are that many Americans living overseas. There's an estimated 9 million Americans living overseas, and in 2020, there were 1.2 million who voted. So we need more Americans abroad to vote so that we can show that we exist, and then they will prioritize the issues that we care about the most, like fixing the tax code. So please make sure you go to votefromabroad.org and register to vote today. Other things you can do, you can join as a Democrats Abroad member if you're not already. You can also volunteer, and you can also sign up for the tax mailing list to keep up to date on tax events and our advocacy work. So I think I'm done with the public service announcements now. I think we'll go, and I can see that there are a number of questions in the Q&A, but I don't see that anybody has any upvoted. I'm sorry, I should remind everybody. So if you see a question that you like, go through and upvote on it. And does everybody see the upvote option? I don't seem to see it online, but hopefully you have it on your screen. But I will hand it back over to Caitlin to go through the questions on the Q&A now.
Perfect, thank you. Well, there's a couple of questions here on the foreign tax credit and the foreign earned income exclusion. So let's start there, as that's the content of our presentation. So one needs to file you said that one needs to file their foreign tax return first in order to claim the foreign tax credit. But if tax was withheld from your income during the year, wouldn't you be able to claim the foreign tax credit on that basis right away? And you're right. The foreign tax credit, there are two ways of taking it and applying it. One is on the paid basis, and the other is called the accrued basis. And you can elect to report and take the credit based on either of those two options. That's another thing that you do consistently year to year, once you've chosen one of those options, to ensure that you're not over applying any of the tools. That said, if you are in a country, which we see actually pretty frequently, the UK is a great example, where tax gets withheld from your pay, and you don't actually have to file a tax return in that country, then the tax withheld from your income is actually considered the tax that is due, and therefore you can apply it and utilize the foreign tax credit without waiting for a foreign tax return to be filed. In other cases, though, tax gets withheld from your income, but then you go ahead and file a tax return and some of that is refunded. In those cases, the tax credit needs to be the amount related to or ultimately due to the foreign government. So you can't take, for example, make a very large tax payment to your foreign country of residence, knowing that some of it's going to come back to you, and take that amount as a credit. So I hope that answers your question.
I've just made it available for people to upvote, I think. Can everybody see it now? Great. Okay, I am seeing the Q&A with upvoting is visible now, and you should be able to see all of the questions too. So I'm so sorry, everybody, that's fixed now. So hopefully you can like the questions and you can see all of them.
All right, so we have a question here about switching from the foreign earned income exclusion to the foreign tax credit. Can you say a little bit more about the downside of switching from the foreign earned income exclusion to the foreign tax credit? I've been using the FEIE for the last 14 years, but I'm thinking about switching to contribute to an IRA. When you discontinue the use, so in this case, you've been using the foreign earned income exclusion for many years. And if you discontinue the use of the foreign earned income exclusion, you won't then be able to use it again for another 5 years. So as long as you can expect to continue to be paying foreign tax to the extent that the credit will be an effective tool to reduce and eliminate your US tax bill, then making the switch is just fine. To the extent that you earn above the foreign earned income exclusion amount, you also may be able to contribute to an IRA without having to switch. There are a lot of different considerations in making the switch, or especially turning off or discontinuing, opting out of the use of the foreign earned income exclusion. But again, as long as your situation will be consistent in the next 5 years and you're confident that the foreign tax rate you're paying will be sufficient to cover the US tax liability with use of the foreign tax credit, then you can go ahead and make that change. We have a question about unearned income sources. So what if all of my income is unearned and from US sources? State government pensions, Social Security, interest, dividends. It sounds like none are excluded. Under the foreign tax credit, under the general default rules, the answer is you're right. None of those types of income are considered foreign earned income, and therefore they wouldn't necessarily be excluded. That said, the treaties in place between the US and many countries around the world have a mechanism to resource some income, and this depends on the country that you reside in. So if with a proper interpretation of a treaty, potentially some of your income types could be resourced as foreign source, and therefore you might be able to take the foreign tax credit on them. And if you're living in a country that taxes you on all of those different types of income, ideally you'll be able to take a mechanism similar to the foreign tax credit in the tax return that you have to file in your country of residence. So the foreign tax credit, of course, is the tool that we use on the US return, but in those countries where there is a treaty, there are typically mechanisms available on the foreign tax return that you can use to reduce in a similar way your foreign tax bill. Okay. With foreign tax credit, after detailing the foreign taxes I paid, I still owe US tax. How do you use carryover credits from previous years? This is a great question, and it's actually a line on the form 1116. There is a line number that is associated with carry forward and carry back of credits. So if you input the carry forward credits from the previous year into that line on the form, it will calculate the total available amount for credit, and you can use that in your calculation to reduce and eliminate your tax for this year. Okay. Let's see, I'm looking for more foreign tax credit and foreign earned income exclusion questions. There may not be any more. Here's a good one from Dawn. If you plan on retiring in the next, say, 5 to 10 years, at which time your income becomes primarily from pensions, IRA versus wages, would that be a good time to switch from foreign earned income exclusion to foreign tax credit? This is a great question. And I think the timing really does matter. In your case, Dawn, if you plan to retire in 5 years from now or 10 years from now, if right now you're paying higher foreign tax credit, higher foreign tax rates on your income than you would in the US, you're potentially missing out on an opportunity to accumulate carry forwards in the foreign tax credit. And what I mean by that is the excess beyond the US tax rate can be carried forward for up to 10 years. So using the UK again as another example, we see people retire and take a tax-free distribution from a pension at the point of retirement. And to the extent that they have carry forwards from the previous 10 years, they can apply to that. They're eliminating the US tax associated with that big income event. So it definitely can be beneficial to switch over to the foreign tax credit some years in advance of your transition back to primarily passive income or pensions versus earned income. So that's something to definitely consider, of course, depending on the tax rate in the country you live in versus the US tax rate, and what your income situation will be and how taxable it will be at the point of retirement. I have a large foreign tax credit carryover and will possibly have some tax due this year. To use the carry forward, is it possible or is it likely that the tax software will apply it when it's necessary using Tax Act? I can't confidently answer that question, unfortunately. As tax pros, we use separate software, so I'm not necessarily familiar with Tax Act, but maybe a participant who is using a similar software might be able to inform that question. All right, so I think we have a couple of other questions that aren't necessarily credit related. So I'll kind of dive in and talk through those because we do have time. Angela asks, well, it looks like Angela's doing her Fbar online. Great, that's actually the only way to do an Fbar. The IRS or the US Treasury doesn't allow paper submissions of that anymore. And then on paper, Angela is doing her 8938 and the 1040 SR tax return. Yeah, no reason you should discontinue doing that. So that's absolutely something that you can continue to do if you feel comfortable filing on paper. Just knowing that the IRS processing times are extremely lengthy. There's a huge backlog at the moment in every different way at the IRS. So as long as you're not in a hurry, then that should work just fine. Fbar dates. So we talked a little bit about the Fbar. The Fbar is the disclosure of foreign accounts. To the extent that you have more than $10,000 in accounts outside of the US, you are required to file an Fbar. And if you look at the instructions for the Fbar filing, you're going to find that it says it has an April 15th deadline. But if you continue to read, it says to the extent that you don't file by April 15th, there's an automatic extension to October 15th. So for all intents and purposes, October 15th is your filing deadline for the Fbar. I'm retired and have pension income, no earned income. I have a pension from the US. Is it true that I cannot offset that in the 1116? And will you have to pay tax on that portion? This actually relates directly back to that question about resourcing income and the use of a tax treaty. A pension that you earned in the States is considered US sourced income unless there's a treaty provision that resources it as foreign sourced. And so that depends on an interpretation of the treaty in the country that you reside in. The IRS informed me that I would not receive the stimulus checks because they did not have time to send them. Anything I can do to get the funds? Well, I'm surprised they even had time to tell you that. We have been spending months and months just listening to IRS music because either they're not letting you sit on hold, or when you do get on hold, it takes 4 hours for somebody to actually pick up the phone. But beyond the IRS processing delays, if you haven't received the stimulus checks for whatever reason, and you know that the IRS didn't send them, you have confirmation of that, you can file to request the amounts due to you by filing your 2020 and 2021 tax returns. There's a line for the recovery rebate credit, and that's your way of calculating the amount that was due versus the amount that was paid. For that situation in particular, and anyone who didn't receive one, there are cases in which the IRS thinks that they sent you something and you didn't receive it because of international mail. So in those cases, there could be an adjustment created by requesting those funds. So if you're able to, I know this is another challenge for international taxpayers, but create an online account with the IRS. If you're able to, again, I know being abroad makes that very difficult, but you can use the online account to confirm whether the IRS thinks that they've sent you stimulus checks or not. Okay, can returns and Fbars still be filed on paper forms, or must they be filed online? And how secure is our private information? Fbars can no longer be filed on paper. So you have to use the BSA filing system with the US Treasury to do that Fbar disclosure. Paper forms can be filed to the IRS with your tax return, but again, expect extremely long processing times. Some procedures, such as the streamlined procedure, have to be filed by mail. So that's something we're doing with some consistency, but seeing very, very slow turnaround time with respect to the IRS response. How secure is our private information online? I don't know the answer to that. I would imagine that the IRS has that pretty well locked down and under control, but I don't have kind of any insight in terms of the IRS systems. All right, are there different rules for dual citizens? there are not. Your US citizenship, regardless of your visa status or your citizenship status in other countries, is what's driving the filing requirement and the requirement to report your worldwide income back to the IRS each year. Okay, declaring your US Social Security benefits on the 1040 to the IRS. Are they not taxable because of the Franco-American Tax Treaty, Section 18? I wish I knew the tax treaties that well, but it's very possible that the treaty prevents the taxation, but you would need kind of someone to evaluate your specific situation, your residency, and whether you're considered a tax resident in France, and then interpret the treaty specifically as it relates to the Social Security benefits that you receive. Okay, I live in the UK and use a UK-based tax advisor to assist with my US tax returns. Can I obtain an online account and grant my tax supervisor access so he can assist with online filing? You can grant your tax advisor power of attorney to interact with the IRS on your behalf. And that involves talking on the phone with them about your account, pulling tax transcripts, which will show kind of the history on your account, but it's not quite as straightforward and interactive, unfortunately, as a system from the tax preparation pro perspective, that we can kind of interact very seamlessly with the IRS on your behalf. It's a bit of a slow process, but absolutely online filing can take place with your advisor. Tax preparers are required to electronically file your tax return on your behalf rather than putting it in the mail. Of course, there are exceptions in which you have to submit a paper mailed return, but that would be a reasonable expectation, is that if somebody is working as your tax preparer, that they're electronically filing the tax return on your behalf. Okay. How can you find out all of the tax stimulus checks that were sent out over the years? So either you're going to need to call the IRS and ask them to provide you that history, or alternatively make the online account where that should be displayed, if you're able to do that. Okay. I filed with a foreign tax credit and have a passive income loss. All of my income is foreign, but I found the allocation of the passive income foreign loss reduced my foreign wages and seems to lead me to owing taxes on my wages. Is that normal? Can you explain? So when we're using the foreign tax credit, there are different buckets of income. One is the general bucket, and that's kind of where everything else goes, everything else being pensions and wages. Then there's a passive bucket, and the passive bucket is investments, interest, dividends, capital gains. And for purposes of the calculation, those get separated out. What might be happening here, though, is that your overall income is being reduced on the 1040, and therefore the amount that's eligible to take the foreign tax credit is possible. It would need to be evaluated, you know, your personal situation would need to be evaluated to determine whether something's going wrong in the calculations there, or if the offset is appropriate to reduce the credit that you're allowed. But if you have some amount of US source income, then it would be reasonable to expect that you have perhaps a small amount of tax due related to that US sourced income. All right, and can book royalties be considered earned income? No, so your book royalties are going to be considered on the Schedule E, and that would not be considered earned income for foreign earned income exclusion purposes.
Wow.
Okay.
We got
questions.
All the questions. That's a first. Well, that's awesome. Thank you so much, Caitlin, for your help. I really super appreciate it. I think that kind of wraps us up here. And I'll just, oh no. So if anybody has any kind of follow-up questions, like I mentioned at the beginning of the webinar, we're going to be sending a follow-up email to everybody so that you have a link to the recording of the webinar and also the slides. So hopefully you found the information on this webinar useful, and do be sure to, drop us an email if you need anything else. We're hopefully we threw a lot of information at you, but this is the first time we've run this webinar topic. So it seemed like it was more kind of like optimizing your tax strategy kind of thing. And I think a lot of people found it really useful. So thank you again, Caitlin. It was really, really great.
Yeah, thanks for having me. It's always a pleasure.
Okay, I'm gonna